This is Steven, founder of Phoenix FXC. I'm going to go over with you one of my favorite types of analysis, which is fundamental analysis. A fundamental approach can be so important to your trading. Despite anybody who tells you that only technical analysis is important, fundamentals play a huge role. I promise you this. Fundamentals are a key that you can learn to unlocking big profits in the market. Now, for fundamental analysis, you're going to mainly focus on how news and economics are going to affect the market pair that you're wanting to trade on. News has a habit of causing huge sudden movements in the market. So if you're on the wrong side of one of these moves, man, it's going to cost you dearly. But if you're on the right side of one of these moves, you make sweet profits. Now, some specific things that you want to pay attention to in fundamental analysis, like I said, are news, the state of a country's economy, interest rates, inflation, different key businesses, financial states, and their financial moves that they make. If a public figure is shot, a big import-export deal, stuff like oil or commodities and stuff. New laws are going to heavily affect things depending on what law and what it's about. Wars, wow, wars, yeah. And even smaller economic events. All of these things you're going to want to factor into your trades or learn just how to do analysis on this, because they play a key role in market moves. Now, I'm going to keep going through stuff like this and really show you the truth to fundamental analysis. This is the kind of information that people lock away and make you pay thousands of dollars for. So pay attention here, guys, because this is really good stuff. Now, a great place to get your news from is forexfactory.com. We actually have phoenixfxc.com/forex news for you guys. We created this so that you didn't have to leave our site and you can just get your news from here. This is awesome. You can see all your news. High impact news just barely happened, by the way, guys. You got some medium impact news in 5 hours and 8 minutes. Stuff like this you can go on and you can say, okay, the GfK Consumer Confidence is leading index that measures the level of consumer confidence in economic activity. So if consumers are confident in their economy, that's a good thing. A high level of consumer confidence suggests economic expansion, while a low level drives to economic downturn. These are key things that affect an economy's pair of whether price will go up or down. If an economy is good, price can go up. If an economy is bad, price can go down. Generally speaking, a high reading, like I just said, is bullish, up. And a low reading is negative, bearish. That means it's going to go down. This literally gives you the keys to different things. So this is JFK Consumer Confidence Survey. This is for German pairs, so Europe. Right there, guys. I mean, Euro USD, this is going to medium affect it. So 50-50 chance it's going to make a big move in the market. This one, however, Jackson Hole Symposium. Jackson Hole Economic Symposium is an annual symposium sponsored by the Federal Reserve Bank, that's so huge, of Kansas City since 1978 and held in Jackson, Wyoming since 1981. It's a forum for central bankers, key thing right there, central bankers, policy experts, and academics to come together to focus on a topic. Guys, central bankers making policies directly affects the markets. It will have high impact. Keep this in mind. Things like this are what you can look at to go over to your trades and say, okay, news is in 5 minutes. I'm going to look at the Euro USD pair or a USD pair. If news is going to be good, the market's going to go up. If news is going to be bad, the market's going to go down. Guys, you can make a lot of money just doing that right there. Don't forget that. That's amazing. So let's get back to what a little bit more information and start teaching you how to analyze things. And like I said, this is the kind of stuff people don't teach you for free. So that people don't teach you in general, even if you pay. I mean, this is golden nuggets, guys. So when analyzing a currency pair, start by analyzing the countries itself. What are the country's political state? If it's USD JPY, if it's Euro USD, analyze the countries that are involved with this, the conditions of the countries. Do they have high debt, inflation? What's going on in the countries? When a country has lower inflation rates, you'll typically see a rise in currency value. Its purchasing power may also increase relative to other countries. The inverse is also true. Countries with higher inflation will experience depreciation of their currency relative to its currency pairs. Depreciation in currency is usually paired with higher interest rates. Key nugget right there. During long deflationary periods, it's common for a nation's central bank to weaken its own currency rate by injecting more currency in the economy. This is usually followed by a purchasing of foreign currency. Guys, right there, look for countries to do that. Japan just did this recently. Key nuggets, guys. Now, higher interest rates in a country will offer lenders higher returns in relation to other countries who do not offer higher returns. This can attract foreign capital to a country and directly or indirectly cause the exchange rate of its currency to rise. If the inflation of a country is much higher than other countries, the impact of higher interest rates may have no effect on the exchange rate. If interest rates are lowered, it's typical to see the exchange rates go down. Now, tying back into news and reports, when a report or piece of news comes out speculating or commenting on what might happen with interest rates, you can usually see quick changes in the exchange rate of a country's currency. Now, it's also important to pay attention to a public debt of a country. We kind of touched on this a little bit ago, but countries often use what is called deficit financing to fund their governments and various public projects. You've heard of the US deficit before. You've heard people talk about it. You've heard people whine about it. You've heard people talk great about it. I mean, the point is you've heard about it, right? So this is usually done to stimulate the economy of a country. However, foreign investors typically find countries with high deficits and debts less attractive. This is why you see part of the reason why you see some people be like, ooh, we can't have a high deficit. This is because high public deficits and debts are usually followed by high inflation. When inflation is high, not only will you see a depreciation in exchange rates, but the debt will be paid off with cheaper real dollars in the future. That's not always attractive to people. A government may even print money to pay all or part of their large debts, which further increases inflation and lowers the exchange rate further, the currency pair rate further. However, keep in mind that earlier we learned that high inflation can also be followed by an increase in interest rates, which can attract the foreign capital and raise exchange rates. So you need to do good analysis on this. If the deficits and debts of a country are too high, foreign investors are likely to get worried that a country might default on its financial obligations. This has happened. Greece, not too long ago, defaulted on so much in its own country and to foreign debtors. Countries do this from time to time when things get too bad. But if this happens, foreign investors will be less likely to purchase and own denominated securities by that country. This is not a good thing. Because when a country is having trouble paying its deficit through its own domestic means, like exporting goods, selling bonds, increasing money supply, etc., often that country will increase the supply of securities for sale to foreign investors in order to lower their prices. We kind of touched a little tiny bit on this earlier, so feel free to go back and re-listen to this. Now, another way for countries to raise the value of their currency is to raise exports by a greater rate than imports. This is called increasing its terms of trade. Now, a country will enjoy a higher revenue from exports and a greater demand for its currency, which in return increases the value of a currency of the country. If the rate of imports are higher than exports, the value of the currency will decrease. Kind of common sense there, guys. Political turmoil in a country can also cause a loss of confidence in a country, and therefore it's going to cause foreign investors to pull their money out of an economy of a country. Foreign investors will then seek out more stable countries, and maybe even seek out competing countries to invest their money in. Not such a good thing. Remember that earlier we learned that when foreign investors pull their money out of a country, it can cause the exchange rate to decrease. In other words, foreign investors will likely seek out stable countries with strong and predictable economic performance. They're going to look for news or reports for clues as to what is happening in a country and its economy. Those clues will help you understand whether a currency pair is going up or down, which is the goal of every foreign exchange investor / trader. So, you guys, all of this stuff, I highly recommend you learn fundamental analysis. It is so key. Study it. Study the news. Study all the things I told you about. Go rewatch this video several times if you need to. This is going to help you, I promise. So thank you for watching, and have a great day.